You open the front door for the first time, the key turns, the lock clicks. You step inside and the smell hits you. Fresh paint, quiet rooms, possibility. You stand in the middle of your own living room and for a second, nothing hurts. The kids are running through the empty hallway. Your partner is standing by the window looking out at the backyard like they're already imagining something. You did it. You bought the house. That feeling lasts about 3 weeks. Then the mortgage statement arrives. This is your life at every level of mortgage debt. Level 1. The comfortable buyer. Your monthly payment is $1,100. You put 20% down. You did everything right. The savings, the credit score, the patient years of waiting until the numbers made sense. The payment is about 18% of your take-home. You barely notice it leaving your account. You still eat out on Fridays, you still take the trip in summer, you still say yes when the kids ask for something at the store without calculating it first. The house feels like an asset, not a weight, an asset. You repaint the kitchen in March because you want to, not because you have to sell. You refinance when the rates drop. You build equity quietly, the way healthy people don't think about breathing. You have a home, not a burden, a home. Most people assume they'll be this person when they sign the papers. Most people are wrong. Level 2, the stretched buyer. You couldn't afford the neighborhood you wanted, so you stretched. Just a little, you told yourself. The payment is $1,900 a month. That's 28% of your income. Technically within the guidelines, technically approved, technically fine. Except it doesn't feel fine. You notice it first at the grocery store. You put something back and pretend you forgot you didn't need it. You notice it when your car needs new tires and you sit in the parking lot doing math on your phone. You cancel the streaming service you never used, then the one you did. The house is beautiful. You send photos to your family. You talk about the neighborhood, the yard, the school district. You don't tell them that you've started checking your bank balance before you go to sleep, not to feel secure, but to make sure nothing went wrong since morning. The pride is real. The pressure is realer. Level 3, the house poor. This is where the identity starts to crack. Your payment is $2,600 a month. You make decent money. From the outside, everything looks like success. The house, the neighborhood, the car in the driveway, the lawn you keep because the HOA sends letters if you don't. But 38% of your income disappears the moment your paycheck lands before you've bought a single bag of groceries. You are cash poor inside an asset. You have a net worth on paper and an anxiety that wakes you up at 3 a.m. in cash. The water heater is making a sound, a low, inconsistent groan you've been timing for 2 months. You know what it means, but you cannot afford to know right now, so you turn the shower up louder and keep moving. Your friends are talking about vacations. You nod and say, maybe next year. You've been saying, maybe next year for 14 months. There is nothing to save. The house owns you more than you own it. And the terrifying part is that from the outside, nobody can tell. Level 4, the denial stage. Something shifted. Maybe the rate adjusted, maybe your income changed, maybe you bought at the top of the market when everyone was saying buy now or get priced out forever. And you believed them because you wanted to. The payment is $3,400 now, and you've started doing the calculation everywhere. At the dinner table, at your kid's birthday party, standing with a paper plate, in the parking lot after church, before you start the car. It's the background noise of your entire life now, a number running behind every moment, never stopping, never resolving. You used one credit card to cover what the month ran short, then a second for what the first couldn't handle. You told yourself it was temporary, a bridge, just until things stabilized. The bridge has been there for 11 months. You refinanced, extended the term by 7 years to lower the monthly number. You paid to stay trapped longer and called it a solution because there was no other word available. Your house is worth more than you paid. You say that a lot now. The equity is real. You just can't touch it without selling. And you can't sell without giving up the school district, the address, the version of yourself you built around this zip code. So you stay, and the cards grow. Level 5, the breaking point. You missed one payment, just one. You told yourself it wouldn't matter. Then the next month was also bad. The phone calls started. You watched them ring. You let them go to voicemail and didn't listen because listening made it more real than you were ready for. You've stopped opening mail from 3 specific senders. The envelopes sit in a kitchen drawer, face down, stacked like you can make them less real by not looking at them. Your payment is consuming 52% of your income. That number should never have existed, but approval felt like permission, and permission felt like safety. And you wanted so badly to feel safe that you signed where they told you to sign. You've started having conversations with your spouse at night, quietly after the kids are asleep. They start with, "What if we just..." And then one of you stops, because finishing the sentence means admitting what you've both known for months. The house might not be yours much longer, and the house is the only thing that still makes you feel like you made it. Level 6, foreclosure. The notice comes on a Tuesday. Nothing about Tuesday prepares you for it. Regular morning, coffee, the kids getting ready, someone looking for a shoe. Then the mail, then a plain white envelope with a return address you recognize but hoped you'd never see formally. You read it once and understand everything. You read it again anyway, the way people read bad news hoping the words will rearrange themselves into something survivable. They don't. You spend an evening learning vocabulary you never wanted to know. Loan modification, short sale, deed in lieu. You write things down on a notepad because making a list feels like control, and control is the only thing left to reach for. The worst part isn't losing the house. The worst part is the morning you explain it to your kids in language simple enough that they understand, but vague enough that they don't carry the weight of it. You watch their faces, you hold it together until they leave the room, then you sit in the kitchen alone, and the house is completely quiet. Here's what nobody tells you when you're standing in that open house, heart full, pre-approval letter in your pocket. The bank doesn't care about your life. The bank cares about the math. The math said you qualified. The math wasn't wrong, and it was just incomplete. It didn't account for the job that changed, the medical bill that arrived without warning, the rate buried in Section 4 of a document you signed without reading closely because everyone in the room was smiling and moving fast and you didn't want to be the one who slowed things down. The math didn't know you were a human being, it only knew you were a number, and the number said yes. Every level of mortgage debt starts the same way, with hope, real, earned hope, the hope of stability, of belonging somewhere, of building something that outlasts the moment you're living in. The question was never whether you could afford the payment. The question nobody asks loudly enough is whether you can afford the payment on the worst day you haven't had yet. You opened the front door for the first time. The key turned, the lock clicked. That feeling, it can last a lifetime. Or 3 weeks. The difference was never the house. It was the number you signed next to.